Ladies and gentlemen, welcome to the AIM Summit webinar on macro trends in crypto markets. I am your moderator, Justin Dennison, Head of Exchange Sales at Equanex. And if you're joining us on YouTube, please like this video and subscribe to the AIM Summit YouTube channel now. I would also like to introduce our webinar partner, Saxo Bank, the industry's leading provider of multi-asset trading and investment platforms. They recently launched their crypto FX and crypto ETP offering, and we're glad to have them sponsoring and speaking at what is sure to be a very interesting session. To move on to the speakers themselves, I'm excited to talk to Steen Jacobsen, who joined Saxo Bank in 2000 and serves as Chief Investment Officer. We're also talking to Manmeet Singh, Director at Blockseed Ventures Limited, an investor in all things blockchain and crypto, I believe, and I'm sure he will have a very unique view on the topics we discuss. Last, but definitely not least, our third speaker is Stanislav Kostyukin, I hope I'm pronouncing that right, who is the commercial owner for Saxo Bank's trader segment. Now, I'd like to start the conversation looking maybe at the crypto markets on a global scale or from a macro trend perspective, and start maybe with you, Steen. Bitcoin is often touted by crypto enthusiasts as an uncorrelated asset. And indeed, if you look at it on a 5-year horizon, it doesn't correlate with equities or bonds, commodities, or precious metals. On the flip side of that, though, in the short run, and as more funds include Bitcoin in their portfolio, it seems to, in fact, be impacted by macro moves. Have you observed the same or not? And how do you see Bitcoin within global markets?
So I think as a chief investment officer, the most important evolution of Bitcoin and overall the crypto space, of course, is that whether you want it or not, you have to have a view on the allocation to the asset. If you run the classic model of efficient frontiers, it becomes somewhat difficult mathematically because, of course, you're looking into a very high volatility assets, which have, as you already alluded to, some negative correlation to the overall market, but you always end up with an allocation of 1 to 2%, and that can, as a maximum. But I think that doesn't take into account the fact that we looking into the future, you have to make adjustment on whether the critical mass, or in technology speak, the network effect is big enough to sustain it as a individual asset. Having followed this market and just disclaiming upfront that we actually have a 7% allocation to crypto in our 100-year portfolio, which is a diversified overall asset allocation model. And that's worked quite well because it's a monthly rebasing. So, the way we deal with volatility is to rebase either up to 7% or back down to 7% month by month. And that has been a huge net contributor to the overall portfolio. But in terms of the directness of your question, I think it needs to be seen. I mean, any correlation that you run, if you run an L square, it's clearly correlated to risk appetite. Recently, over the last 3 quarters, 4 quarters, I have noticed in correlation terms that it's become a bit of a debasement hedge in US dollars. So in other words, this rand up of spending that we've seen, in particular in the US, but also in Europe, has some mitigation effect if you're along the space. So a long answer to a short question, but basically time needs to tell. And I think the correlation is ever shifting, but as you say, with this institutionalization that we see, the risk on, risk off will follow a more classic example. And as a portfolio manager, you probably wish that also as a first derivative will mean low volatility going forward, but that we haven't seen. If anything, we've seen rising volatility where Ethereum trades at almost 100% and Bitcoin at 70%. So, yes and no. Yes, in terms of adoption, no in terms of volatility coming down, reflecting that same adoption.
And so if I understood correctly what you said earlier, you are actually trading that volatility. So actually the volatility, whether it's in Bitcoin or Ethereum, ends up being a positive if you've got the right strategy for it. Is that correct?
Time will tell if it's right, but the way we conduct our long-term asset allocation, which is a 100-year portfolio, and I think the name itself dictates what it is. But what we do is a monthly rebalancing. So think about, when you have the big move technically was last autumn when we broke $12,000 in Bitcoin and started to move up. And you could say if we have kept it at 7% all the way through, we would have, of course, made a huge amount of money, but we were also taking the consequent drawdown. What we did do instead was to month by month reduce at the time when it was going from 12 to let's for Christmas say 30,000 every single month. We took profit out of the market. Similar over the course of the last 6 months where we've seen Bitcoin dipping, we have been buying again up to 7%. So we will at all times have 7% exposure. Doesn't make us smart. It's just, I think, a good mathematical practice to dictate yourself to or decide what kind of allocation you want. We want 7%, and having that 7%, we are constantly monitoring that as a level to keep.
Okay, very, very interesting. Manmeet, I want to go to you. I'm guessing you probably have a very different focus, at least maybe from the fact that you wouldn't be rebalancing to enter or exit the position. Steen might be more of a trader and enjoying that kind of price difference. I suspect you're a long-term holder of equities in blockchain projects and also of cryptocurrencies. How do you look at it? Is it more of a store of value, an inflation hedge?
Well, thanks. So for me, Bitcoin is the original cryptocurrency. It is maybe over time become much more of a store of value and not really a payment protocol anymore. It's not constructed adequately enough for that to happen, although there are layer 2 solutions and eventually layer 3 solutions that will bring a lot more functionality to Bitcoin. But it was that first generation protocol. I focus on the infrastructure side of Bitcoin. So the way I lever myself in Bitcoin is by being a miner. So we are invested in a large mining business that is entirely captive mining, and that's our position. And for us, the decision there is, that's ultimately the cheapest way to procure Bitcoin, to earn Bitcoin or whatever have you. And instead of trading it or so, our strategy has been to take any of our retained earnings in that case and reinvest it back into the mining business. So that's the way we look at it. Our entire outlook and focus is in blockchain powered projects, both on the equity side and to a lesser degree on the crypto side.
And Manmeet, I don't know if you can say, but so you're mining coins, which you receive, I would say, at a somewhat regular or predictable, rate. Do you then immediately exit or sell those coins to get cash and, as you say, reinvest it in the operations themselves? Or do you have some kind of a strategy as how you profit from the mining itself?
Sure. So it's important to understand that I come from a early stage angel investing accelerator model kind of background. So investing early in great ideas, great teams, and so on, and startups is what I am most personally sort of comfortable with. So in the mining operation, I and thankfully the rest of the board and the shareholders carry the same mindset, and that is as we earn and generate Bitcoin, we liquidate whatever is required for our fiat related obligations, and the rest we just continue reinvesting back into the business to grow the business. So it's Bitcoin is a heavy or Bitcoin mining, I should say, can become a significant sort of capex investment business, and very efficient, but it does take a bunch of capex. And if you have good, clean, renewable energy at cheap prices, then it's a wonderful business to be in. And that's what we focus on. We don't necessarily go and trade it. We don't leverage it so much. We're just keeping our head down and just following basic principles, which honestly nobody's complaining amongst the board of the shareholders thus far in all these years.
Okay, that's great to hear. And you also mentioned about the the energy type or energy source, and I want to talk about that later. But before we do so, I also want to hear from Stanislav. I understand, Stanislav, that you're working also at Saxo Bank, so you might have the very same perspective than Steen. But do you have any thoughts on, the place of Bitcoin within global markets and the best way to view it?
Absolutely. Thank you, Justin. As a representative of the active trader segment at Saxo Bank, I think my view is somewhat different from Steen's and certainly from Manmeet's. Of course, strategy-wise, amongst clients, what we see is many do use this volatility that Steen mentions as their bread and butter. For a trader, provided you manage to manage your risk, control your downside, it is a very good market to work in because of the large price moves, provided you have good money and risk management, and the right product choice, which I think we'll get onto later. We do see a lot of these directional, event-driven and technical traders. There's also more investor type clients that take a more long-term view, either through physical crypto, the ETPs or ETFs, and that more fits into Steen's vision of the 100-year portfolio and the 7% allocation. But certainly I agree with Steen very much that when dealing in the crypto space, you have to be mindful of the volatility. We've seen a 25% move in Bitcoin in the last 7 days, 7% today. You really need to manage your downside, control your risk. And at a global level, more macro, I do think that the crypto space has reached a scale which is difficult to ignore at this stage. The future trajectory we can discuss amongst our participants here, but I do think that crypto is here to stay and can be seen as quite a useful hedge, both against let's say government action or against inflation, what Steen was alluding to earlier. I do like this anecdote very much. If you've been following the crypto space for the last maybe, 12 years since Bitcoin was established in 2009, I'd like to notice that it did emerge out of the ruins of the great financial crisis. There was a wave of adoption in 2013 as well. I happened to be in Cyprus at the time where we suffered from a pretty significant banking crisis. And at the time, many investors, when they saw this precedent of banks or governments bailing in deposits, fled into the crypto space as a decentralized hedge against this kind of geopolitical uncertainty. And I do think that we see these waves of adoption that typically appear to be correlated or triggered by geopolitical uncertainty, whether it's the great financial crisis, the European debt or banking crisis, and of course in 2020 that's the COVID pandemic. So I think that's also quite an interesting pattern we're seeing.
Definitely, and also I think a big narrative or theme within the crypto space is a lot of people are looking at all the money that's being printed by central banks, not just in the US but globally. And kind of seeing that as, let's say a trigger to maybe consider Bitcoin just because of the limited supply and the idea that it's a safer way to put cash rather than just leave it in the bank. So yeah, very interesting. It definitely was born out of that. Manmeet, actually, you mentioned ESG, or at least the energy source and those types of concerns. I actually want to circle back around that. So regardless of the strategy one would deploy, for people who want to hold the actual Bitcoin, a topic that's become very important recently is the environmental cost or the energy consumption that's linked with crypto mining. And Bitcoin being the most successful cryptocurrency out there, it's also the one using the most electricity. Do you think that poses an existential threat to the growth of Bitcoin? Or do you think this can be remediated maybe by carbon credits or different energy sources or maybe other cryptocurrencies?
I think that FUD, as we call it, has already been debunked so much and so often and so many times. It's almost embarrassing, to be honest. But here, ultimately, here are the facts, right? However you slice and dice it, most reports say that today the whole entire Bitcoin network is using something like 0.3% of global energy production. So we're talking about 71, 72 terawatt hours annually. For a digital asset, a cryptocurrency that has provided such an opportunity to most of those who the traditional financial services industry have not catered to. It provides open access. It's completely decentralized. Every 3-letter, 4-letter regulatory body, agency, government out there and so on, hackers, you name it. Tons of folks have tried to meddle with the network, but it continues to trudge on. It is a network that has been growing globally. Now, that's one part of it. The other part on the ESG side, sure, electricity being the largest sort of cost of mining business means that a lot of the earlier miners, or those who started early on or who were very opportunistic, really didn't care, or maybe didn't worry too much at that point about where the energy source was coming from, whether it's green energy or not. And the cheapest energy out there that might have been available for most of them was non-clean energy. But over time, many miners, new miners, including ourselves, one of our first primary, before we made an investment in mining, was that we would go in mining only if it's green energy. And for us, I can only speak to myself, the philosophy was very simple. For cryptocurrencies, Bitcoin in particular, and any other cryptocurrency, or the entire blockchain space to become massive global scale and beyond what it is today, even at all in $1.5 trillion, with about 48% or so, 49% or so being Bitcoin today. For this to become truly global scale, you need to get institutional involvement, both in terms of adoption of blockchain and as a technology for solving problems and products and services built on blockchain core protocols, but then also cryptocurrencies as an alternative to the fiat system, or at least a supplement to it. Doesn't have to be a replacement, it could be a supplement to it that provides some very interesting use cases and opportunities. And so for that to happen, clearly ESG is an important criteria. Therefore, green energy is an important criteria. That's where the entire globe is shifting at various paces, different countries, different industries, whatever have you. So for all of that to happen, or to support that, we made a very conscious decision to only go for green energy. So we mine in Norway, where it's 100% green, 95% hydroelectric, 5% wind energy. And some of the latest reports out there, if you look at, in the US, you have the Bitcoin Mining Council, or even the Cambridge data, I believe, they are constantly refreshing the numbers in terms of usage, as well as what composition is green energy. All the estimates today point to that over 50%, some cases 56%, some saying 51% is already green energy. So 0.3% of global annual electricity consumption, 51+% of it being green energy. And most of the new expansion that's happening is green energy. So I'm just not sure, unfortunately, that this narrative of this ESG complaint for Bitcoin has just been prevailing again and again and keeps getting circulated. But the facts very conclusively prove that that's not an issue anymore. It was an issue before, maybe, but certainly not anymore. And now with China having pretty much stopped all Bitcoin mining, where you had the large chunk of the non-ESG compliant sort of mining operations, that further accelerates this. Where's more new mining coming in? A lot of it is coming in the US, right? And there you have very strong considerations, especially from the investors that are funding these operations for an ESG narrative, right? So I don't see this as, I don't think it's a problem right now, and I certainly don't see this as a problem going forward. It's just narrative now.
That's great to hear, especially as a crypto enthusiast myself. I'm very reassured by the idea that all the participants are definitely taking that into account. Steen, I see you there. I want to include you in that conversation as well. Do you think that funds, despite Manmeet's comment, do you think that funds nowadays are concerned about ESG requirements or aware of the development that there is in the crypto mining businesses? How are they approaching that? Are they asking questions? And is there a workaround, or are some people just avoiding crypto because of that altogether?
I think that ESG also involves, of course, governance, and I think governance is a bigger issue in the short term than the environmental impact that Mahit addressed. I consider myself a centrist in the middle of the road, typical economist on one hand, on the other hand, on all these issues. But I don't think the selling is as clear as Manheed explains it. And it is not, I mean, Manheed is by far superior to me in knowledge about all this stuff, but from a person who needs to take a decision on investment, it's not as clear cut, at least for now, because as indicated, there is a number of reports on both sides of the coin. And I think one thing I learned over the last 5 years, whether we talk about ESG or we talk about green transformation, is there are no fact-based evidence to support anything. I mean, the fact that we today can't even compare whether an electric vehicle is comparably better than a fossil energy engine, at which mileage does the comparison work in favor of the electric vehicle? The fact that we can't even compute that, which is a simple exercise in my opinion, tells me that the field here is full of people who are playing to their conviction rather than to fundamental facts. Doesn't mean that either Manheed or I am wrong. It just means that it's very difficult to navigate. And I know investors as far as they will always sway on the side of defensive. So the straight up answer to your question is absolutely is a major concern. And I think and as Manheed has just done, I think the proof needs to come from the supply side of this. People like Manheed going in front of TVs and similar like this and explaining that is exactly what we're trying to do. That is the only basis on which we do these investments. I think it's very good and very constructive, but it needs to reach the realm of the investors that sits behind these investments. And I think increasingly, as we come into a competing offering on digital between the central bank issued money and the decentralized money, I think that conversation needs to be accelerated. And I think the burden is on this industry, the crypto industry, to prove their point rather than the other way around, because we know that the government powers and regulatory powers will have to have the marginal better argument to allow this to happen. So somewhat skeptical, and I think ultimately, and I think it's been illustrated quite good with this conversation already, Bitcoin doesn't have a good user case. If from an investment officer like me, he has some aspect of a potential to be a store of value, but as just been told, it's not a payment system. It was worked around as a payment system to essentially replace Visa and PayPal. The second evolution became Ethereum, which has economy of scale issues. So for me, I am, as an investor, looking for the tell sign that we get the user case where it's being used, where it sits on top of this digital currency as a real competitor. So in my mind, and again, I'm a nobody in this, but I don't think the winning cryptocurrency has been born yet, because I think technology, Krypton is far behind, but it has the limited amount of issuance. Ethereum was, in terms of contracts, the better ones, but they are standardized contracts. So, the third adaptation, of course, is going to be this proof of stake, is going to be that the contract is going to be specified individually and the likes, and the DeFi and FTEs and the likes. But I'm a positive in that I have always believed in technology over fiat money. I have to believe in that, but I don't think the argument is as strong as it's been put. But it's, again, just my personal opinion.
No, but totally understood. So on one side, there's the fact that Bitcoin might be a bit clunky to actually replace payment providers or current infrastructure. And if it doesn't, then maybe that whole energy consumption, at least to you, doesn't seem like it's worth it, and would definitely be a concern, at least for a good chunk of the investors that do worry about ESG. Even though, as Manmeet has explained, it might not be a valid concern, but until you can actually prove it to the regulators or observing entities, that remains a concern. I think it can actually be summarized by someone who posted in the Q&A box, energy consumption is a concern, full stop, by Trevor Beagrie. So I think we can close at least this part of the conversation on ESG that way. Stanislav, I wanted to bring you into the conversation. Let's assume that some people at least do want to get exposure to crypto assets. While traditional assets are well integrated in the traditional financial infrastructure, crypto remains harder to access for most funds. for many different reasons, right? Whether that's mandate or infrastructure and custody or maybe venues. In your opinion, what is the best way to get exposure? Is it through ETFs and ETNs or maybe CME Futures? Or is it on crypto exchanges, decentralized exchanges, or maybe later via banks? Can you share your thoughts?
You missed out crypto FX as well, which is another option. But I have to say that over the last year, this most recent wave of adoption, of course, the amount of choice for investors out there has really exploded. The space has developed extremely fast, and the selection of ETPs, futures, crypto exchanges, derivatives has really increased several fold. And I get this question a lot. What is the best way to get exposure to the crypto space? And I think that there's no straight answer to this. It really depends on your own view, on your investment horizon, on your risk appetite. And if you just look at, let's say, the Saxo platform, there alone, you'll find an OTC derivative where you can trade with leverage, long and short. That's for the more active trader with a high risk appetite, a short-term strategy. You've got the ETPs, of course, which provide a more long-term view. Those also have an expense ratio you should be mindful of, but they do give you some cost efficiency over the long run. And of course, there's the CME Futures, which are quite institutional focused, as are options these days. I'd say the options market still hasn't developed to an extent where it can be generally acceptable for the retail audience. And naturally, there's the physical crypto, where, let's say, if you're looking to take the long-term view on Steen's 100-year portfolio, you're really looking at ETPs at the moment or physical crypto. And here again, it's really a question you need to ask yourself, whether you're comfortable holding a crypto wallet with security phrases or an account on a crypto exchange, whether you're comfortable with the security concerns around that, or perhaps you'd like a more traditional way of accessing the market through an ETP, where you have a middleman, a fund manager that insulates you against these risks. And once again, for the more active traders on a short-term time horizon, you're really looking at futures, which roll over, which do have some liquidity concerns, or OTC derivatives like CFDs amongst many providers, or let's say crypto FX in the case of Saxo. One more thing to note, I think, is the repercussions on taxation, where there are significant differences between trading using one avenue of investment, like the physical crypto, against, let's say, a derivative. And I've got some personal experience reporting taxes on crypto in Denmark, for example, this year, where there was a 55% capital gains on physical crypto transactions and a 27 to 42% tax on capital gains from derivatives on the very same crypto. So those are other elements you need to take into account besides your risk appetite and investment horizon.
That's a great explanation. Thank you so much. And I did want to give you the opportunity to talk about the crypto FX product, so I'm happy you did that. You also mentioned taxation. We're going to talk about that in just a few minutes. But before we move on, Steen, I wanted to get maybe your input. Of course, you've talked about the portfolio and how you're maybe managing Bitcoin within a broader allocation. But I was just curious, do you have any other thoughts on, well, let's say profitable or good strategies that you would recommend for people trading crypto? I don't know if you trade crypto on a personal basis. You've got different schools of thoughts with people holding Bitcoin just for the long term, but maybe they can stomach, the massive volatility, like a 50%, 70% drop. Other people will use derivatives, which Stanislav mentioned. Do you have any thoughts on that, on different strategies to trade crypto?
Only the way I traded both personally and in a 100-year portfolio. And I think for someone like me who is far inferior to you guys on knowledge on the working on the industry, I consider it a twofold investment, and I think people need to do the same. So one, I considered it an optionality on what Mahid talked about on a call option on the failing of fiat and debasement of currency and everything else. So I'm basically saying if I allocate, my 7%, I can afford to lose 7%. I don't think I will lose 7%, but I think I can afford to lose 2, 3, 4% on this investment. The upside, if, and I believe he is right, and will have critical mass, and the network effect will take it, and the mid-cap ratio, which is the way we measure valuation in this market, is increasing, then I have an upside. And certainly, for the record, I had a huge contribution from exactly this exposure. But it is a optionality. It's 0 or 1, so to speak. And number two, of course, more directly, I have the concept, and as a believer in technology and being a technologist in itself in terms of investment, I would rather be long some small fraction of a technology into a world where the amount of debt increases in size. And finally, the rule, how do I actually trade? I trade in the most liquid taxable asset that I can find. So for my use, I am a very primitive guy. So like the likes of ETN is very, very good for me because I only need to adjust once a month. And through the ETNs on an ETF, I can actually access in something that the authorities that is going to do my tax payroll will accept. So for the case of Europe, you have a very, very clear distinction on tax. So one, optionality; two, a call option on the failing of fiat and debasement; and three, I trade in the most liquid, most taxable asset. Of course, there's a number of people in the world who would be saying that I'm absolutely crazy to want to be taxed, but I live in an environment regulatory-wise that I need to be taxed. So understand it from the perspective of an investor: high liquidity, high transparency on tax, and the optionality plus the call option.
That's a perfect, brilliant answer. I really love that. Stanislav, I just want to use that answer and also what you mentioned about taxation to ask maybe a long-winded question, but as we talk about different, there's a pop-up that just came up. As we talk about different platforms or products actually to trade, one topic I do want to address is taxation. And so in the crypto space, taxation was a topic discussed almost never, say 3, 4, 5 years ago. But with the recent bull run and also the involvement of more investors, retail and institutional, the question of taxation has become a more pressing issue. How do you see that evolving for the crypto space? Will exchange plug into third-party providers, of accountancy systems, or how can we best advise clients on that topic in general, or maybe help them optimize?
Right. Yes, thank you. So on the practical aspects, in terms of taxation, I already mentioned that you should be aware of these differences in the tax rates on capital gains, depending on which jurisdiction you're in. I can speak for Denmark, for example, where physical crypto is taxed differently to the ETNs, which are also taxed differently to gains on crypto derivatives like CFDs or crypto FX in the case of Saxo, where there is some room to, let's say, reduce your tax burden depending on product choice. But again, you should also be mindful of other costs and the general risks that the particular product wrapper poses. That being said, I also think that ultimately where the crypto space is going, and we already see signs of this, is a kind of combination of traditional finance and open ledger, blockchain technology, crypto assets. And I do believe that with time, tax authorities will become better at tracking activity on crypto exchanges, on external wallets, and whenever, let's say, crypto proceeds will enter the traditional space to buy long-term assets, a house, a car, etc., they will be subject to taxation. So it is time to be mindful, pay attention to the kind of rules around trading and dealing with crypto. And by the way, I also really like Steen's analogy of this optionality around the crypto, where essentially a small allocation in crypto assets in your portfolio gives you this opportunity potential to earn multiples on your investment, or on the other hand, that investment can go to zero. And I think we can also learn much from the dot-com bubble, where there was this shock and it filtered out a big part of the unviable tickers, companies, or crypto coins out there. And I'm not necessarily saying that the crypto space will drop by 78% like the Nasdaq did back in 2000, but this optionality element, I really like that analogy, where your investment could go down to zero, or you could stand to gain multiples, and it really depends on, again, your investment horizon and your choice of cryptocurrency to hold.
Definitely. Great. Thank you so much for that feedback. Manmeet, I want to bring you back into the conversation and ask you a super blockchain and crypto related question, which is Steen and Stanislav have talked about taxation, the fact even that they enjoy it in the sense that it actually allows them to trade an asset in a compliant way. Now, my question to you is, as that taxation or the view of regulators grows, do you think that might push some of the crypto traders that operate on centralized exchanges to decentralized exchanges, where there is no KYC and everything really happens on the blockchain and through smart contracts? Manmeet, maybe you can give a super quick explanation of decentralized exchanges. Maybe some people in the audience don't know. And then, what's your view on that? Do you think a lot of people are going to transition to that because of the regulatory oversight?
Okay, good question. So decentralized exchanges are effectively exchanges that are run by code. There's no, ostensibly, there's not supposed to be any individual or organization behind it. You have blockchain and you have smart contracts and you have code, and the code operates the entire exchange, manages the order books and execution and settlements and so on and so forth. And so, the notion is that since there isn't an organization or a group of individuals behind it, except for whomever might have created the code and compiled all that together and then launched it out onto the internet, it's not managed by any central entity. Now, I think over time, what we'll end up seeing, and what we're seeing bits of this already, is that it's very difficult to have a truly, decentralized exchange. If nothing else, there's always a team or a group that's out there that's publicized themselves and said, hey, we've created this, or we are creating this, and then we're launching it out. So when regulators and legislators, anybody out there wants to let's say, pick a bone on some issue around that particular exchange or come cracking down on it, they have a means of going and identifying someone, right? And trying to tap into somebody. And that's one issue. Two, just given the nature of the concept of a decentralized exchange, the large chunk of capital that exists to deploy out in capital markets is institutional. It cannot play from their own regulatory and compliance requirements. It cannot deploy to such exchanges. Will you always have, or can I foresee that going forward, you will still have, shall we say, the more libertarian elements of our ecosystem and the more, individuals? And let's be very clear about this. There's a difference between those who manage money and the ones whose money they're managing. The guys who own that money, who are these sort of LPs or investors into all these products and funds, a large chunk of them who've taken the time to understand the technology, who've taken the time to learn about it, maybe from their kids or grandkids or their colleagues or peers, or went ahead and practically hired young, brilliant minds and said, hey man, teach me what the hell is this stuff, so that I'm not just trading something based on some random TA analysis that I use in my traditional world and try and make some, wonderful assumptions and conclusions to then dish out as investment advice. I actually understand what the hell this whole thing is and what coin A versus coin B and protocol A versus protocol B actually signifies. And on that basis, I'm making certain decisions. So that money flows into a lot of these decentralized exchanges as well. They just don't tell you about it. And the only way you might start seeing some of this is if you look at your traditional investors and your account holders or your LPs, and over time their sort of expected allocation to you starts dwindling, or there's bits and pieces here that are being shaved off, and they're laughing away somewhere else in in Monaco or wherever it is, then something else is happening, right? So that's one. The retail element. Now, this is the other part that I think a lot of people tend to forget. Blockchain and cryptocurrencies has an actual core technology piece behind it that my kids understand intimately. They were born into this virtual world. They were born with iPads and iPhones and all of this in their hands. They play online video games. They understand digital assets way better than we do. And they understand, or at least they have their perception of a value of a digital asset that is inbuilt in them from the minute they start handling a Nintendo, an Apple iPhone, or a Samsung tablet, whatever have you. So for them, this is no longer, the questions that we are tackling with across, our older white hair or bald like me group is not what the next generation is tackling with. They're beyond it. It's kind of like me, as when I first started working, I worked as a banker, and I desperately tried to get my parents to get a credit card. I said, dude, I got you. I'll get you this credit card. It's awesome. You don't have to carry these bundles of cash. You don't have to stand in front of this ATM and all this one. My dad said, no, you know what? I don't have the money to pay for it. I'm not buying it. I'm like, yeah, no. Don't worry. It's a credit card. Doesn't mean you're borrowing the money, but no, conceptually, not getting there. At some point, I think almost 11 years later, finally convinced my dad, get a credit card. Now he loves it. Generational shift. Whether we understand it or don't understand it, that generation gets it, and they are going to play and take all this technology and all the ecosystem around it further than anything we could conceive. We're struggling to figure out how to deal with it right now. What we're missing out is, where's that next generation taking this entire technology? Just look at NFTs. Yeah. If you understand these non-fungible tokens and art pieces and various things and sportsmen launching their images and creating all these cool NFTs that do some amazing stuff, and smart people are jumping into that, understanding it, nibbling around it, playing with it. It's something I hadn't expected. And I'm in this industry now since 2013. If you'd asked me 5 years ago, NFT is going to be a big thing. Even about 2 years ago, there were people in my ecosystem that were talking about NFTs, and I was like, yeah, I don't know, not too clear about it. I go and watch my son buying all these online, whatever paraphernalia, and I go, oh wait, you know what? Maybe there's something here. And now look at where the industry is, right? Sotheby's and Christie's and all, they're auctioning NFTs out there. How much more legitimate do you want it to be than that, right? What kind of compliance did they have to go through to do it? And then the banks, right? Every single bank out there saying, oh no, blockchain, terrible, these crypto guys, they're scamsters, they're this, they're that. And now what? Yeah, we've got a product for you, and we've got a product for you, and we're launching a trading desk. And so this is how it's all going to go forward, whether we buy into it today or not. And the argument then of centralized versus decentralized becomes one of this. The more this gets adopted as a technology, the more people understand it, the more it will be regulated. It's already on that path very strongly, very vigorously. It's already on that path. I think that's overall a good path, because we have, yes, unfortunately, lots of bad actors in our industry that have gone and done some pretty nasty, scammy things over the last several years. So that needs to be weeded out. But that regulation and regulatory oversight, if it's smart and amenable to the innovation and provides the necessary, securities and comforts to the investor that it claims to. It hasn't been very awesome at doing it with traditional financial services either. Let's put that, clearly. Banks aren't exactly, overall, the most clean institutions either. We can go down a laundry list of bank scams and so on and so forth, right? LIBOR, wonderful example to talk about. So my point is very simple. Regulations are good for the industry. Regulations that are done that don't stifle innovation, but genuinely provide protections are good. That allow more institutional adoption. That would only grow the industry. And I, for one, am very pro that pathway.
Great to hear. That's a very interesting feedback on decentralized exchanges and also on regulation coming to the space. Actually, on the back of that, Steen and Stanislav, it's a question for you both. A question I'm really curious about, but that might be tough considering your position at Saxo Bank is, as Manmeet was explaining, decentralized exchanges. There's a lot of advances made via blockchain technology, which hint at a world where trades can happen via smart contracts and on a designated blockchain. Not necessarily a decentralized exchanges on a decentralized exchange, but maybe happening on blockchain and via smart contract. And so that would essentially erase the need for many of the intermediary, right? So the admin, the middle office, other functions, along with just the time linked with processing trades. Is that something trading platform and exchanges are conscious of and wary of? Or do you see a major roadblock to this ever becoming a reality?
It's pretty clear that the driver for a bank like us is to reduce the marginal cost of transaction. So similar to a network, we need more users for lower retained earnings in terms of the spread. So you can say it's a process already happening, and some banks are doing it better than others. And some banks, again, especially the Swiss bank, are changing to a different model where they're going back in time and moving into this bespoke service in the asset management only. But for us who are engaged in digital and digital online delivery, it's pretty clear that the economy of scale model is everything. So critical mass, similar to the value of the crypto space, and the crypto value of the future banks will be critical mass in terms of the uses. Again, Metcalfe's law on that. So for me, very, very clear that the marginal survivor in this game is the one that has the lowest marginal cost, but at the same time, at least in the case for us, has a multi-asset. So you need a platform, I think, in the future where you can access all of Manheet's ideas, all of my conservative ideas, and you need to be multi-generational. And I think, the counter argument to, and I'm not making the counter argument, but what we need to understand is that, and I think Stanley Druckenmiller, which I respect hugely, made the point there are something in the US called West Side money, West money, which is basically Silicon Valley derived young people, like Manheet says about the kids, and we're learning from them. The problem, however, is in a world where I operate, which is the asset management side, 90% of our wealth is held by people who are more than 60 years old. So for this transfer of income, transfer of technology, and let me make clear with a smile here that I've made an institute a rule at Saxo that we should not read any research written by anyone who's older than the age of 40. Because I think, as Manheet said, he's qualified. I'm sincerely, like him, lack of hair, but just my age disqualified me for understanding West money and digital and everything, despite the fact I intellectually try on a daily basis. My point is that the vast majority of wealth in the world sits with people who are 60 years and older, who, similar to Manheet's father, will be slow in adoption. So I'm not saying that the path here is uncertain or it's not moving forward. It is moving forward, but it is all depending on that this 90% quartile moves down to the under 40-year-olds, the young generation coming up. Unfortunately, the whole inequality, and now I talk as a macroeconomist, the whole full employment narrative, the whole inequality, concept we have in the world today is driven by the fact that these people are left behind, not in technology, but in everything else that is rooted in the old world, which makes the gap between the two worlds even larger, and to some extent support Manheet's support, because they have no alternative to believe in anything but decentralized currencies and everything else, because that is the one way they can get one up on the 90% quartile. I can see Manheet is desperate to come, and so I would love to hear your version of that as well, Manheet.
So short answer, you're probably going to hate me again on this, but it is happening. So one of my portfolio companies is actually taking traditional financial assets. So we're talking about home mortgages, we're talking about warehouse financing, we're talking about SME loans, working with the 5th, 6th largest trustee in the US for their entire business, working with one of the largest financial institutions in Europe. So we're doing about $3 billion worth of transactions for securitized assets. So any sort of like an ABS, MBS structure, everything from origination all the way through to securitization, all entirely in the blockchain. And what that actually does, even though it might not be doing it today, again, because of inertia, we need to go up the learning curve here for everybody. But what ultimately you're talking about is you have this one immutable, ledger system out there that all the intermediaries can plug into, where as an investor into that MBS or ABS, I have real-time NAV sight on everything to do with that pooled asset. I can go down to that individual loan level detail and see stuff from origination, from, if you want, that depends on the issuer now, from everything from the KYC onboarding documents that were filed that are stamped by and authenticated by a blockchain protocol, everything from there through the entire financial life cycle of this asset, I can see it, which means I can calculate NAV on my own without having to wait for a monthly, quarterly, and oftentimes half-yearly report from a product manager trying to tell me what's happening with the asset. So this is happening today. This isn't a hypothetical. This exists, and yeah, we've got one company that's doing this very successfully and growing leaps and bounds. This will disintermediate a lot of the intermediaries. Let's be clear about it. At some point, if you have that level of access to the underlying, and you have right sort of analytical engine or tools built into it on top of that, which financial institutions should be putting in for their investors, then as investor, I can run my own analysis. I might not need a host of the intermediaries that exist today and that take, I don't know, what is it, 2, 3, 4% of the entire transaction costs, whatever it is. One can disintermediate that and then spread that between the genuine value-adding participants in the value chain. Now, to me, honestly, that's why I invest in this company, because I think that is and should be the future of capital markets. Whether that happens or not, maybe I got to wait for my kids to be the decision makers.
Great, thank you so much for that kind of answer, Manmeet. I think we don't have that much time left on the webinar, and I do want to take some time to answer questions from the audience. And I'll go maybe to you, Stanislav, with a question that actually relates to what we were talking about before with the exchanges, the regulation, and so on. One question from Jim Erickson is, what do you think will happen to unregulated exchanges like, say, FTX or Binance? And I don't know how familiar you are with those names, but do you have any thoughts on those exchanges that allow to trade crypto but might not be operating under best practices?
Sure. And I think that's actually a super relevant follow-up to what both Steen and Manmeet we're talking about, this whole discussion around decentralization and regulation. I completely agree with the other two gentlemen that regulation, I don't see it as a risk. If anything, I see it as an opportunity to give the space more legitimacy and more of a supporting framework in order to grow further, attract more institutional capital. I think with names like Binance, FTX, even Robinhood, all these large incumbents in the crypto space are starting to realize that it's not a fight against the regulator. It's more cooperation around this nascent space that's still developing, that's still on a journey of discovery. It's around cooperating with the regulators to formulate a framework which fosters future growth and development and innovation, as Manmeet says. And we already see signs of that with Binance, for example. I believe recently, yesterday, announcing that they're seeking a successor to their current CEO, CZ, and looking for someone with a strong background in regulation. And I doubt that's, the point of that is to avoid regulation. It's more to navigate, cooperate, and build this infrastructure. So I do think that gradually the traditional financial space and the pure crypto space will merge into one and find some common ground. We're going through this process of this tug of war, and ultimately we will find some common ground where the space can really develop further.
Thanks, Stanislav. Other questions? I want to keep them short and sweet because then we can ask a few more. One question is from Rohit Satra, which is asking Manmeet, are you saying that in the near future, one will see no intermediaries?
No, that's absolutely not what I'm saying. But what I am saying is that the more transparency you have on the underlying assets that you're investing in, whether they're pooled or even individual assets, the less you need intermediaries to validate and vouch for whatever information you're seeing. And that is a process. How quickly, how slowly depends on the innovation level of the existing financial intermediaries, who are the ones that are more amenable to adopting these technologies. And the regulatory framework around it. Right now, everything has to work within the regulatory framework. So if a certain asset class requires X number of intermediaries in between, because by regulation, that's how that asset gets approved to be traded, then that just has to exist. But does the technology exist today to take out a bunch of those intermediaries? Yes, it does, absolutely.
Wonderful. Thanks, Manmeet. Steen, a quick question for you that I wanted to ask, actually. I think at some point you mentioned CBDC, so central bank digital currencies, which at this point maybe seem inevitable because pretty much every country out there is doing some kind of experimentation with a blockchain version of their currency. Do you think that's a positive, a negative, something that is meaningful for the crypto space, or not at all?
I think it's positive in the sense there is a learning curve, of course, that needs to lean on the decentralized part of it. And I also think, just for the record, that it's necessary because the societies around the world, especially the Western societies, is moving to a model which entails that you have to have very, very negative real rates to pay for a world which is unproductive. The way to do that, of course, is to have negative interest rate. And negative interest rate only works in a digital world because physically, you and I, Justin, if we give it charged 2% negative, we'll just take money out of the bank or invest it in crypto or whatever. So digital is the conduit to which we can operate a model of very negative interest rate, real rates, and negative real rates overall. And I mean, if you look at the German government, which is one of the strongest from a fiscal position, they are indicating in the next 10 years, we're not going to go to zero interest rate. So they need it. They need it simplistically because they cannot operate the train unless they have the tracks, and the tracks is the digital currency. And I think that will have a huge positive spillover effect because, and I think Mahit and Stanislav did a brilliant job explaining why the regulatory framework needs to be embedded and seen as something positive, because it also narrows the gap between the decentralized and centralized in terms of both the investor, but certainly the regulators. But it's, think about it, here I am, someone who has time every day to study whatever I want, and I understand like what we know about the brain. We understand 10% of the brain. I understand 5% of crypto. I do understand everything man he said, and I'm bored of most of the arguments. Maybe the speed is the only difference. We have the speed limit, but I it's very difficult even for me, who has enough time to actually invest in understanding this. Imagine someone who has a family office with $1 billion. How does he get there? And, the fact that we have digital and decentralized currency, you need to lean, if you're a centralized currency, on the decentralized network effect and the failures to some extent on what happened in that space.
Okay, very interesting. And I think I heard some comments actually from the Bank of England earlier today that mentioned something relatively similar to what you were saying about just needing digital cash as opposed to physical cash in order to accommodate for those rates. I think we're right at the end of the seminar. I just want to thank everybody who dialed in for listening into this conversation, and of course to the speakers for taking the time to share, all those insights. Also, I'm asked to remind you to save the date for the AIM Summit in-person conference in Dubai on the 11th and 12th of October 2021. So the registration is now live. And remember, if you're joining us on YouTube, please like this video and subscribe to the AIM Summit YouTube channel now. Thank you very much.